Hello, good evening, everyone. Welcome to the IME Digital Disruption PMS webinar. I am Shagun and I will be your host for this event. I want to thank all of you for joining us on this Thursday evening. For those who have been interested in this space, the IME Capital PMS on digital disruption was launched last year in February 2023 amidst extreme pessimism when many were doubting the viability of digital businesses. However, we are very happy to report that our digital disruption PMS strategy achieved a 100% absolute return within just 1.5 years of launch. Ashi Anand, the founder of IME Capital, will take you through some very interesting aspects of this unique PMS. Ashi has been an institutional fund manager for over 23 years and now is a thought leader, sharing his views regularly on shows on prominent business channels. Owing to his illustrious career with some of the country's top AMCs like Kotak and Pro ICICI, Ashi has an inherent understanding of how funds work and how they are managed. If you have any questions during the course of the webinar, I would request you to please post them in the chat section and I will get to it at the Q&A session at the end. And now, without any further delay, Ashi, over to you. Ashi, you're on mute.
Thanks for that, Shagun. Firstly, I'd like to thank Shagun for the introduction and thank you everyone for joining today's webinar. This topic is something that we are very interested about at IME Capital. It is a strategy, it's a very unique strategy that we launched a year and a half back, focused on what we believe to be the particular segment in India, which is likely to drive the largest amount of value creation. What we will do in today's webinar is I'll take you guys quickly through what the overall investment philosophy is, why it is that we believe that this strategy is something that can outperform significantly over the coming decade, and what really we are looking at. So let me just jump right into the presentation. Give me a minute, I'll just share my screen. Just want to confirm, the screen is visible, right?
Yes, Ashi, we can see it.
Okay, great. Thank you. Okay, so just to kind of give a framework to the today's discussion, when we're talking about digital companies, these are the kind of companies that we are talking about. The strategy is very, very clearly focused on companies that are digitally native and digital first platform businesses. So we will not include traditional companies that happen to be using digital to help augment the overall business, but we're really looking at companies that are focused on being digitally first and digitally native. So what is IME's digital disruption strategy? Firstly, it is a listed digital platform thematic PMS strategy. We will invest exclusively in listed digitally native platform businesses and not, as I mentioned, traditional businesses. We follow a private equity style approach to listed investing. What we mean by this is it will be a concentrated portfolio with a buy and hold approach, very heavily concentrated towards the companies that we believe to be the expected winners amongst digital platforms. There are very clearly identified stock selection criteria that I'll come to in greater depth later on. But effectively, we're focusing on companies that have disrupted traditional business models. They've achieved a certain level of dominance and scale where there are very large competitive barriers to entry, giving a clear path towards supernormal profitability over the longer term. We believe there's a very clear potential for large long-term value creation in this space. And lastly, while it is a private equity style approach to listed investing, this will be an actively managed portfolio where portfolio weights and exits will happen based on evolving market, industry, and company conditions. Now, one important point on why this is so important for investors. Currently, public market or listed investors have a lot of misunderstandings and misperceptions around listed digital platforms. There's a very large amount of uncertainty around what used to be very high levels of losses and what is currently low levels of profitability. And this leads to people questioning the viability of these business models. Because profitability is still not a focus and is still fairly low, There's an inability to value digital platforms on traditional profit-based multiples such as price earnings, price to book. And because of this, a lot of listed investors, and including kind of diversified, professionally managed mutual funds, PMSs, AIFs, have very, very limited exposure to this theme. We've done an analysis where we've actually analyzed the total percentage that the mutual funds have to listed digital platforms, and that is sub 2%. Now, by being the only pure play listed digital platform strategy in India, IME Digital Disruption helps correct this current underrepresentation of digital platforms in investor portfolios, giving investors an ability to build concentrated exposures to what is clearly India's fastest growing yet misunderstood space. Now, just before we get through the balance part of the presentation, this is just broadly what the portfolio has done. We launched this portfolio in Feb 2003 at a time when there was complete widespread pessimism around this entire space. The strategy has actually done incredibly well since then. We've up over 110% in a year and a half, and we've been quite consistently outperforming. Now, it's just important to understand that we don't expect this level of outperformance to necessarily continue in the future, though we continue to be extremely confident about the ability of this theme to substantially outperform traditional diversified strategies. Now, while it is a concentrated thematic strategy, one important element to understand is if you look at the industry allocation of the current portfolio, we are actually well diversified across sectors and industries. What this portfolio basically gives investors an ability to build in their portfolios is exposures to the fastest growing companies across multiple segments. So you have the fastest growing finance companies, the fastest growing consumer companies, the fastest growing B2B companies, the fastest growing ticketing companies. So the ability to build a diversified portfolio of the companies which are seeing the highest levels of growth is what is really very interesting. The other important point is that there is very few small companies in the portfolio. It's primarily a large and mid-cap portfolio. And given what we're expecting from these companies, we believe over 3 to 5 year period, this will largely be mostly a large cap kind of portfolio, given how large these companies are likely to become. Now, just to give you a framework in terms of how today's discussion will be proceeding, we'll first just understand from the start what we mean by digital platform and network businesses. And very importantly, explain why is it that these companies actually make large losses in early years and why that creates a framework for supernormal profitability over the longer term. We will show how this is an established and a proven global playbook where companies have invested, grown, turned profitable, leading to supernormal value creation. And lastly, we will actually explain what makes us so confident of the same happening in India. We'll show how growth is very evident, how the path to profitability is also evident, and how value creation will just naturally follow. So starting off, let's understand digital platforms and how these platform businesses evolve. Now, firstly, what is a platform or what is a network? A network is basically nothing more than a business that connects mutually dependent groups of participants, buyers and sellers and say other participants in a way that is benefiting all sides. So you have buyers and you have sellers, and in order for a transaction to happen, buyers and sellers need to connect. Platform businesses are businesses that actually connect buyers and sellers. And when you're doing it from a digitally native perspective, you can do so extremely efficiently. So this is really the focus of the kind of companies that we're looking at in the portfolio. Now, when you're sitting and trying to build a platform business, there are 4 specific stages that you necessarily have to go through. And that really explains how profitability kind of moves the way it does. So effectively, the first stage of building a network business is where you're trying to solve the cold start problem. Now, if you have a network business, you need participants on both sides. A buyer will not come if they're not sellers, and a seller will not come if they're not buyers. Take Uber or Ola as an example. It's Uber and Ola is only attractive for the consumer because they're taxi drivers on the network. And for taxi drivers, it's only interesting to be on the network if there are enough consumers. When you're starting a business from scratch, the main focus is to try to get participants on your network before your network is optimized. This is something which is referred to as a cold start problem, and the fact that both sides need critical mass. Now, the only way to really do this is via aggressive loss funding, where you make it so attractive for people to join that they join even before the network is optimized. And typically, from a funding perspective, this would happen at a seed or series A round, where now, and if you just look back, right? If you go look back in Indian platforms during 2010 to 2018, this is why Uber and Ola used to be cheaper than an Ola. This is why Swiggy and Zomato would deliver food with no delivery charges and huge discounts. This just trying to get people onto the network. Now, once you have got people into the network and you've achieved a certain amount of mass, you still remain in an aggressive investment mode. And this is primarily because you're trying to achieve two very, very important outcomes of a network business. You keep investing in order to, one, reinforce customer stickiness and loyalty. You are basically trying to reach a point where it becomes impossible for a customer to go back to a traditional way of interaction or traditional way of transaction. Secondly, large network businesses these industries tend to evolve into natural monopolies or duopolies because all participants try to move towards those specific networks where there are the larger amount of buyers and sellers, because those are the most efficient networks. Because you are going to evolve into either monopoly or duopoly, it's very important that you become one of these two key players. So until such point that you've not ensured one, customer stickiness and loyalty, and the fact that they're unlikely to move away. And secondly, while the industry is still emerging and the long term two or three winners have not been established, these companies will not focus on profitability and will continue to invest aggressively in order to build the value of that network. Now, however, once these two important objectives are met, that is when you move towards phase three. And there's one very important element as per our understanding of network businesses. Companies, digital platforms will not come for an IPO until they believe that this is the last round of funding, because going forward, they can focus on monetization to generate cash flows. That is when they come in for an IPO. Now, once you have established these two parameters is when you can really focus towards monetization. Now, what happens is once you know that your customers are stuck to your network, you can start doing a few important things which can dramatically improve your profitability. One, growth investments, or what's called customer acquisition or customer loyalty cost. Huge discounts to get them onto the platform. These can reduce dramatically. Pricing power improves and various forms of fees can be introduced. There are various areas of cost optimization that you can start focusing on, and operating leverage starts to play through. Now, you can already see this in listed digital platforms in India. Ola and Uber are now at a premium to non-AC taxis. Swiggy and Zomato introduced delivery fees in 2020, have started introducing platform fees. Discounts have reduced substantially. Once you know you are one of those winners and consumers are not going to go anywhere else, right? You can really start tweaking your pricing power and you can reduce a lot of costs that were required to get people onto the network. And what happens is that as long as you have strong competitive barriers to entry, this leads to the very clear pathway for supernormal profits and value creation over the longer term. This is primarily because the marginal cost of serving incremental transactions on a digital platform, on a digital network, are very, very low and much lower than traditional businesses. Every incremental revenue, the flow down towards profitability tends to be very, very high. And which is where in our kind of longer term projections, we actually seeing these companies earning very, very high levels of margins and very strong cash flows. Simply because you have a lot of the costs have all been recognized upfront, and you really get very strong payoffs over the longer term. Now, this is just a diagrammatic way of showing customer journey. There's a large investment to get the customer onto your platform. You will first lose money on that customer for the first 1 or 2 years, but as long as that customer is sticky, as they get more and more comfortable with the platform, the spends keep increasing, my cost to service them keep reducing. And therefore, this becomes a very, very valuable, highly predictable, recurring, profitable revenue stream. So that is effectively understanding these four stages is very important to kind of understand how these businesses evolve, because that is really the game that we are playing on this particular strategy. Now, one last point is that if you're looking at investing in this entire space, right, we're all aware about how much value is migrating towards digital platforms. We actually believe that IME Digital Disruption is the lowest risk way of playing the space. If you're investing in a venture capital or private equity fund, or actually investing directly venture capital or private equity into companies, you're still investing in companies that are in stage 1 or stage 2, where the long-term business sustenance has not been proven. Companies that are going into an IPO or have IPO'd have actually passed this important stage 2, have established the dominance, have established customer stickiness, and therefore the chance of failure reduces dramatically. Now, because we have a very rigorous stock selection criteria that focuses on identifying the long-term winners, we actually end up being able to really focus on companies that have moved past all of these stages where levels of risk tend to be very high, where there's a very high degree of certainty about long-term value creation. And growth is still very, very attractive to be able to drive supernormal returns over the longer term. So that's just an overall foundation of digital platforms and how we really see them evolving. Now, let's just understand why we see this as a very clearly established global playbook. This is something, what we're seeing happening in India from 2020 to 2030 is something that we believe is just a copy paste of what you've seen happening in the US between 2010 and 2020. What you have seen is that digital platforms in the US have made substantial losses before they broke even. All of this was really meant to drive hyper revenue growth. So growth rates which were extremely high for, especially given the markets that they operate in. You can see this both in terms of revenues and user bases. So the whole model is invest to build scale. Once you have achieved that scale, and we will also be sharing this presentation with you guys at the end of today's webinar, you can actually go and see, we showed how US digital platforms actually entered the stage 3 of monetization around 2010. This is when various companies stopped offering services for free. YouTube started having ads, Google came up with ads, which came up with premium paid services, YouTube came up with premium, YouTube premium. The moment they started focusing on monetization, just look at the pace at which tech earnings have outpaced non-tech earnings in the US. The level of earnings kind of divergence is extremely disproportionate. You see this at the overall market levels. And even if you compare kind of specific companies, if you compare an Amazon to a Walmart, CY10 to CY19, we've specifically not taken CY20 onwards because there was a COVID impact that actually benefited them even more. We wanted to exclude that additional benefit that they got through COVID. But even before the whole COVID boost, the way an Amazon would have outpaced a Walmart, the way a Netflix would have outpaced a Disney, it really proves that this whole model of investing upfront, building your competitive barriers to entry, building your user base, which is loyal, and then starting to focus pays off very handsomely over the longer term. And while you've seen this in profits, you've also seen this very, very clearly when it comes to value creation. The extent to which a NASDAQ has outperformed overall benchmark indices, Tesla has outperformed traditional OEMs, Amazon has outperformed all other retailers, Netflix having outperformed a Disney. There's another way of also looking at this. If you just look at the top 10 companies on the basis of market cap across different decades, and we've just highlighted which of these are tech companies. If you go back into 2009, there were only 2 of the top 10 companies globally were digital companies. In 2020, 9 of the top 10 are all digital companies. No company in history has ever generated $1 trillion market capitalization. 4 digital companies have crossed that particular mark. If you even see the weight digital or tech companies have in overall indices, the the S&P 500 started with 13.4, it's currently 42%. For China, it was sub 1%, it's currently 31%. We expect something very similar to play out in India. A lot of the companies in our portfolio, we would actually expect them to be part of the major benchmark indices over the next 5 to 7 years because these companies scale so considerably. Now that we've understood this global playbook, right, of invest upfront, build your moats, then can focus on monetization, and this leads to aggressive monetization, what makes us so confident of the same thing happening in India? Now, effectively, it's just a simple equation. Growth, according to us, is very evident, and we'll prove to you what makes us so confident of these companies being able to grow in very high numbers over the coming decade. We will show why the path to high levels of profitability is also very clear. And if both of these things happen, it's a very clear recipe towards long-term value creation. Now, before we get to what makes us so confident about growth, it's important to understand a simple principle when it comes to investing. In order for value to be created in the companies that you're investing in, it's very important for those businesses to grow. What we've got here is a simple chart which shows that the companies that have grown faster have compounded market cap at a substantially higher rate than companies that have grown slower. What makes this chart very important is that because listed investors are this is such a new space for them. When you invest in mutual funds, PMSs, AIFs, your exposure to what is the fastest growing segment of India is actually in the low single digits. And this is a fundamental problem and a disconnect. And that is what the strategy helps identify. Now, what makes us so confident about business growth? Firstly, you have very strong enablers in place for digital adoption. Internet penetration has risen significantly, driven by basically cheap smartphones and cheap data. You have UPI, which has been a phenomenal success. Nowhere in the world have you seen digital payments been adopted so fast and so aggressively. It's driven by very, very strong government initiatives on various kind of digital parameters. And COVID has also helped accelerate the growth. Now, these elements really create a very, very strong foundation for kind of growth going forward. And you are seeing this very clearly. India currently at 85 crore internet users is the second largest internet market in the world. Now, while you have 85 crore internet users, the penetration levels are still very, very low. If you're looking at online food, for example, this is 8.5 crore annual transacting users. If you look at monthly transacting users, this is 5 crores. This compares to 50 crores plus in China. You look at online shoppers at 18 crores, China is close to 100. Across different segments, online penetration is substantially lower than what you're seeing in China and in the US. Now, what makes us confidence of this kind of online penetration bridge being gapped? It is important to just go back here and see that internet penetration has actually accelerated in recent years. There is a very clear digital journey that consumers go through. When you first get onto the internet, you start with initial interaction on free platforms such as a Facebook, a Google, a YouTube, WhatsApp. Once you've gotten comfortable with using the internet is when you start off with certain initial commerce, right? You may use a payment app, you may use Netflix, you may book a ticket online. As you get more and more comfortable is when you start maturing. You start using new age digital apps like a Swiggy and Ola. You start being comfortable with higher ticket purchases. And importantly, this journey is still something that people who have even been on the internet for over 10 or 15 years are still going through. People from urban India who've been digitally savvy from the start are getting more and more comfortable doing higher ticket purchases online, buying furniture online, buying luxury goods online. This journey is something that we're still in very, very early stages of, uh, that we're still in very early stages of. And you can see this very clearly in terms of while internet users are growing at a 14% CAGR, online shoppers are growing at 26%, e-commerce is growing at a 33% CAGR, and this whole growth is something that we expect to really continue. Sorry, just give me 1 minute. I don't know why there's this one red line which is coming here. Okay, thank you. Okay, now another element when it comes to growth is that when you are looking at kind of how fast this growth is happening, a lot of these customers that were basically, so a lot of these platforms that we use and are ubiquitous today did not exist 10 years ago. You know, when we built the startup, and we were amazed by how rapid this is. Swiggy and Zomato have not been around for more than a decade. Netflix has been around for less than 10 years. It's about 8 years. WhatsApp was only introduced about 8 years. The speed at which people are moving towards digital platforms is something which is kind of really, you've never seen this kind of pace of adoption ever in history. Um, Now, we all know about the Indian consumerism theme, but one important element is that people underestimate how digital platforms are really the best play of this Indian consumer. And the reason for that is if you're just looking at penetration, we keep speaking about penetration. What is going to drive penetration to levels which will surprise all market participants, according to us, is decadal changes in consumer behavior. The primary consumer of today, right, people in their 40s to their 50s, only got exposed to the internet in college, only started using smartphones by the time they were already working. The whole app based ecosystem only came about by the time they were in their late 30s, early 40s. They were used to traditional ways of transacting and they've had to adapt to newer form. But they're still very comfortable going to a shop. They're still very comfortable dealing with an insurance agent. The new age, the consumer of tomorrow, right, which are people in their 30s and early 30s and in the 20s to the 30s. Look at people in the 20 to 30 age group. They've had smartphones since the time they've been in school. By the time they were in college, the whole app-based economy has already been in place. For them, the de facto mode of transaction is actually digital. And this will actually lead to digital penetration levels, right? Really surprising on the upside because the consumer of tomorrow will be using digital platforms at levels which will be much higher than the consumer of today. Now, effectively, what all of this leads to is that we've obviously all aware about the hyper revenue growth that we've seen in these companies. You've been able to see companies scale at levels that are ridiculous when you compare them to traditional businesses. Paytm, within 2 years of launching their loan product, has actually crossed SBI cards in terms of annual disbursements, which took, and SBI cards took 25 years to reach that mark. Delivery within a kind of 10-year period has substantially overtaken all other traditional logistics businesses. Nykaa, in terms of GMV, is one of the largest kind of BPC platforms in the overall market. The level of scale is something which is just something you've never seen before. So growth is something which we are very confident about. Now, however, it is very important to address this whole question about profitability. We've explained this from a theoretical construct in terms of why digital platforms lose as much as they do initially. But what makes us so confident about them turning profitable in the future? Now, in order to understand that, you really need to understand the cost structures slightly deeper. We've just taken two specific cost line items. If you're looking at ad spends and employee spends, and you compare digital platform businesses on consumer facing platform businesses to traditional consumer businesses, look at the way ad spends significantly outpace your traditional businesses. Look at the way employee spends significantly outperform traditional consumer businesses. It is very important to understand that there is nothing in the business models of how these companies operate that require them to spend more than traditional companies over the longer term once these businesses mature. In fact, if you understand the way these businesses operate, these numbers, there are so many efficiencies of operating digitally that both of these numbers should actually be substantially lower than traditional businesses over the longer term. These levels are elevated primarily because they are in a hyper growth phase, still trying to get more and more customers and really trying to play that longer term game of ensuring that they capture this very large opportunity. Now, if you actually go in a bit deeper and you go into individual line items, what you see very clearly across companies are very, very specific areas that you can identify as being hyper growth investments where there can be substantial leverage that can play out over the longer term. Zomato still, even as of today, is still paying over 55% of its revenues to its delivery partners as availability fee, which is not recouping in terms of delivery charges. Nika spending uh, on the fashion business on ads is at 45%. Paytm spends 33% on payment processing. Payment processing charges on loans are close to zero, a whole new monetization line. You're seeing a Policy Bazaar still spending about 53% on advertising. All of these are costs that can reduce substantially over the longer term. Now, when we launched the strategy in Feb 23, these companies were operating at very, very high levels of losses. Right. In our call at that time, it was exactly the same presentation that we had made when we launched the strategy. Just some of the numbers have been updated, but the core thesis remains the same. Our thesis was very clearly that as these companies have moved to IPO, they have achieved certain levels of dominance that allow them to focus on monetization, and they can now really focus on kind of pricing, reduction, cost reduction, and various other levers that they have in order to improve profitability. And what you are clearly seeing is costs have reduced and margins have gone up, and you've seen this across the board. And that is really what's driven the very strong returns that we've seen in this portfolio over the last year and a half. But importantly, we believe this is still very early in the journey. The growth pathway is still very, very strong over the coming decade. And we are still very early in terms of how much these companies have in terms of ability to flex their kind of various monetization levers that they have. Now, just broadly in terms of the way we see this overall panning out, and I'm just happy to kind of tell you that this is one chart that we've had to modify. We've had to actually bring forward projections in terms of when we expecting these companies to turn profitable, because they've actually been able to focus on the monetization levers a lot faster than when we were expecting when we launched the strategy. So broadly, the way over FY24, most companies are kind of towards the end have achieved kind of PAT break even. FY25, 26 is where you will see them consistently increase their profitability levels. However, they will still be very, very difficult to justify on traditional PE multiples because they're still operating well below their longer term margin potential. We believe as you go into FY27, 28, these companies are going to be generating very high levels of profitability, generating very strong cash flows, and across the board, people in the markets will actually recognize them as the very valuable franchises that they are. We believe they'll be looked at in similar lights as, but when you're getting to FY27, 28, we all know about the way Bajaj Finance, Hindustan Lever, Nestle's are looked at. The profitability, the cash flow characteristics of these companies are going to resemble those companies as we move towards this period. Now, one very important element, and I'll probably we can spend some more time on Q&A on this, but across the companies that we're investing in, we see very, very clear competitive barriers to entry, which actually help protect these companies against new players entering this market, and which really allow this whole long-term pathway of growth and high profitability to emerge. Now, this is the last element, right? If growth is going to be very strong, and if these companies are going to turn very profitable, right? Value creation is actually expected to naturally kind of follow. Now, it's important to kind of understand that value creation has already happened in a tremendous way in India. But unfortunately, this has happened in the whole startup and VC ecosystem. India has the third largest number of unicorns globally. You have multi-billion-dollar companies been created, the vast majority of which did not exist a decade ago. Right? You're seeing this by the very strong growth in kind of venture capital investments into India. Now, the unfortunate part about this is while there has been tremendous value creation, this value creation has the fruits of this value creation has actually all been enjoyed by global venture capital and private equity funds. The majority of Indian investors have failed to participate in this because it is so difficult to actually access some of these deals. Now, IME Digital Disruption helps correct this. Now that kind of these companies have started to get listed, it provides investors a direct way to actually participate in this very, very strong value creation that we are seeing happening in the Indian digital space. Now, let me just spend a couple of minutes explaining our strategy slightly more in depth in terms of how is it that we look at and how is it that we identify companies. I just want to kind of re-emphasize how, because of where we are positioned, this really becomes the lowest risk manner in terms of being able to participate in this whole digital disruption space. There is a large universe of listed digital companies, and there's some very attractive companies coming up from in terms of the future pipeline. However, it is important to understand that we are not looking at running a diversified fund which will hold all of these companies. We are focused on identifying what we believe to be the long-term winners. And therefore, this is going to be a very, very concentrated portfolio. And we expect this to be highly concentrated, even kind of 2 or 3 years down the line, because it is a private equity style approach. Concentrated bets on those companies that we believe have the traits to become the long-term winners. And we don't necessarily believe all companies on this list would actually have those traits. So what is it that we really look at when we are trying to identify companies? These are the following parameters that need to be met in order for a stock to be included in the portfolio. One, very clear evidence of dominance. We are focusing on companies where the digital platforms, where the network has matured, where we believe they have what it takes or they already are one of the top two players within its specific niche. And there are very strong competitive entry barriers. Now, one very important competitive entry barrier is once you have one or two dominant players in a niche, it becomes very difficult for a startup to raise funding required to go through stage one and stage two of building a platform business when there are already two established players. This lack of funding itself becomes a very, very clear long-term competitive path to entry. Right? The requirement to have to burn thousands of crores just to turn profitable. It's very difficult today to find someone willing to give you that money in a field where there's already winners established. The companies need to be addressing a large addressable target market, allowing for 20, 25, 30% CAGR growth to kind of continue over the coming decade. We are not so fussed about the path, about profitability in the near term. What is very important for us is the path to profitability over the longer term is something which is clearly visible for us. And that the business models allow for very high levels of profitability to emerge. Something that is very interesting to us is the optionality potential. Once you have a digital platform and you have users that are very used to interacting on that platform, the ability to enter new lines of business and offer that to your existing customer base is something that we've seen globally and also in India can add tremendous amounts of value. A prime example is Zomato's acquisition of Blinkit and how well Blinkit has done. Paytm entering kind of loan distribution and various other kind of segments. The ability of these companies to enter strong adjacencies and create large incremental value, and not all of this is something which may even be visible today, is something that we believe could drive stock returns well ahead of whatever it is that we are projecting. Lastly, whenever we are buying a company, whenever we are holding a company, it's very important that we see our long-term models, which are built on fairly conservative assumptions, show very clear value creation potential. A couple of important points in terms of the portfolio construction. It will be a highly concentrated portfolio. We expect it to be within 7 to 15 stocks in the near term. And even while it may have 10 or 12 stocks, we believe a high level of concentration towards the specific companies that we believe have what it takes to win. This stock number and concentration may reduce as the number of listed options increase. While you are concentrated at a company level and at a theme level, there's actually fairly strong diversification that we've been able to already create across different niches. We've seen that in that original kind of industry allocation chart and on the first slide. This will be a large and mid-cap focused portfolio, primarily because we're really focusing on companies that have achieved a certain level of dominance and scale. We will be following a long-term private equity style investment approach as long as the companies are growing the way we see them fit. The idea is to possibly sit, hold them, and let them compound wealth over a long period. We will not look at trading in and out because of 1 or 2 week quarters. However, if the moment we see a fundamental deterioration in the business, we will mostly exit, right? So it is, while it is a private equity long-term buy and hold, it is actively managed, and we will keep optimizing portfolio positioning depending on how we're seeing things to evolve. Now, let me just quickly okay, just one other very important point before I get to the current portfolio. It is important to understand that while we are very positive about this longer term potential, it is important to understand that there are clear risks when it comes to digital investing, right? It is complex to value these companies given the fact that you have to build out these longer term models. Stock volatility can be very high. No one should invest in the strategy who's concerned about how the strategy will perform in the near term. In a specific year, while we've enjoyed strong outperformance over the last year and a half, honestly, we would not be very concerned if markets are up 10-15%, the portfolio is down 5-10% in a particular year. We're really focusing on the 5-7-8 year growth potential, and we believe that is something that will drive a lot of value creation. However, volatility can be very high in the near term given how concentrated the portfolio is. Timing when this value creation could happen could be fairly difficult. We said this when we launched this in February 23. We really didn't expect companies to do as well and as quickly as they did at that time. A path to profitability may be extended if they choose to enter new growth investments. Customer loyalty may not be high. There can be future disruption risk, right? There also founders may have limited ownership because the levels to which they've had to dilute to grow. Now, active management of this portfolio is basically crucial to navigate this risk, right? And we will keep optimizing this as we going along. Let me just wrap up this my part by just very quickly taking you through what the current portfolio is, just so you get some kind of a flavor before we kind of move into Q&A. So this is basically our current portfolio composition. Like I said, primarily large and mid caps. We are fairly well diversified across different sectors. And a top 5 holdings, which account for almost 80% of our portfolio, are Zomato, a Policy Bazaar, a Nykaa, a Paytm, and an Info Edge. Each of these companies are companies that we believe really meet the specific criteria that we've laid out. Thank you everyone for such a patient listening. I'll now hand this over to Shagun. Very happy to take any questions and answers that participants may have.
Thank you, Ashi. Actually, we do have a few questions, so I'm going to get to them immediately. Saurabh Burma is asking, do you have this kind of comparison for Chinese companies as well?
So one important thing, I don't have this on hand. This is definitely something that we can share. But what you've seen in China is something which was very similar until 2 or 3 years back, right? So you saw tremendous value creations in the Alibabas, the Tencents, various tech companies in China, very similar to what you had seen in the US, had significantly kind of outpaced the overall economy. I can show you one slide off the kind of cuff, which does kind of show this. And this actually on the deck itself. Give me just 1 minute. Sorry. So if you're just seeing the level to which, right, tech has increased in weightage in China as compared to the overall benchmark, right? That itself is indicative of how much value creation has happened in Chinese tech. However, what has happened and is really unfortunate is the government has been extremely aggressive in terms of adverse regulations against tech and just overall regulations in China, not just against tech, but against capitalism in general have been very, very adverse over the last 2 or 3 years. And that has actually destroyed a lot of the value creation that we've seen in Chinese tech over the last 2 or 3 years. But if you just see the same premise, right? They've invested, they grew, they created a tremendous amount of value. However, given how authoritarian the kind of Chinese government is, they've actually gone and come out with regulation that has quite adversely impacted them, including stuff like taking kind of tech founders away and making them disappear and various different elements, right? But otherwise, yes, you have seen something very similar play out in China.
Actually, Bhavya's question, there are actually a few questions, so I'll try to combine a few of them. A, how much is the overall AUM in this strategy? What is the minimum investment amount, the associated fees, average returns expected over the next few years? These are some of the questions, and also asking if the potential is so high, why is this strategy not followed by other institutions? We have a lot more questions after that, so I'll just go through them a little faster, if you could.
Okay, sure. So just very quickly, currently, so when we launch this particular strategy, right, what happens is in markets, right, it's generally kind of AMCs tend to launch strategies when the theme is very, very hot. We actually launched the strategy at a time when everyone was running away from this theme. And therefore, this is something that really was arguably quite difficult to market at a time when these companies were making losses, etc. At an overall level, we manage about 100 crores of discretionary AUM at Valcreate. Digital of that is still under 15 crores, but it's important to understand a couple of elements. We have not really marketed the strategy aggressively. We've not gone to external distributors, and this is a much higher level of risk. Given the fact that the strategy is now really starting to kind of outperform and a lot of people are getting a lot more active, we are now really taking this to market a little more aggressively, and we do expect it to scale. Importantly, the strategy can kind of be managed at 300, 500 crore. The companies are large enough to be able to manage a fairly large fund size. It's been small primarily because it is particularly kind of niche, and we've really not been focusing on marketing too aggressively. We really wanted to create a long-term track record, get certain info taken to market more aggressively. In terms of the fees, it's basically, and it's there on the presentation, it's either a 2.5% fixed fee or it's 1.5 fixed and a 20% of profits above a 10% hurdle. The minimum investment is 50 lakhs. However, we do have an option of being able to break up the 50 lakh minimum across other strategies that we have. So we also have a diversified strategy called IME Concentrate Microtrends, right? So for an investor who may have a 1 or 2 crore investment portfolio, 50 lakhs in pure digital may seem too high for him. We do have an ability to say, okay, fine, we can put 25 lakhs in digital and 25 lakhs in concentrate microtrends, etc. Shagun, sorry, what were the other questions?
Why aren't other companies following this? Why aren't other institutions following this?
So that's an interesting point, right? What happens is that if you just look at traditional fund managers and you look at the way the listed market really focuses, they really focus one on the short term. Secondly, I'm just trying to move up to the slide, right? Secondly, most listed fund managers who've been around 15, 20 years are very used to price to earnings, price to book, right? You're sitting and valuing companies based on their profitability. I don't think the markets have really spent the amount of time really understanding the longer term. The second thing is that the level of volatility in the strategy, right? Given the fact that you are building highly concentrated portfolios, it's very difficult for a mutual fund with retail investors to launch something, and which is where if you see there are digital funds in the market, but they'll include a Kotak saying they've got 811 as a digital. They'll include a HUL saying they're creating some vendor app, right? None of these are digital companies. They do this because they can't handle this level of higher levels of volatility. There's also, I would argue, a slower level of appreciation of why these companies lose as much, why they're not going to turn, why they're still at low levels of profitability, and why they'll turn highly profitable over the longer term. We believe 2 or 3 years down the line, this will become kind of, by the time you go to FY27, FY28, your normal diversified flexi cap mutual funds would probably have 15-20% of their portfolios in these kind of companies. But by then, a large amount of the value creation would probably have happened.
Um, Ashi, what is the view on the Swiggy IPO? Rohit Garg has asked this question, and will that be part of the portfolio? And after this, there are a couple of questions about Paytm and Blinkit as well. So, that's where we're heading to.
Okay, so let me not comment too much on
Swiggy.
so just I'll say certain comments that I can make, right? Because obviously what we're going to do in the portfolio in the future is we can't kind of indicate that on a public call. But Swiggy definitely looks very interesting to us. Zomato is one of our top weights, right? We probably see this as an overall theme and diversify a bit between Zomato and Swiggy. That said, Zomato is very, very clearly a leader as compared to Swiggy across different metrics. They are well ahead. So what really is important is that when the company does go in for an IPO and as it lists, what is the level of discount that is available to Zomato? And that will really, and that is something that will really drive how much we probably have in Swiggy and Zomato. But Swiggy being in the portfolio, I'm assuming unless that discount really narrows too substantially, is something which seems quite clear because I think this food delivery is a very, very valuable network business, primarily because it's a three-sided network. You have customers, you have delivery partners, and you have restaurants. For anyone new to come in and try to build all three together, right, and get someone, consumers, when your delivery partners, as in it's just very, very difficult to replicate. So yeah, we are positive on the Swiggy IPO, but let's see where it trades at.
Uh, the question by Nitin is, why is Paytm still such a strong contender despite multiple regulatory issues and recent performance downslide? Or are we only focusing on certain business verticals of Paytm? I've taken this question because a couple of people have asked similar things.
Sure. So Paytm is very interesting. Let me just explain what's happened with Paytm, right? Paytm, there are two parts of Paytm. There's one which is their core business, which was really running a tech business, which is the Paytm app, which is very, very efficient at being able to transact and kind of create UPI transactions. And the entire app ecosystem was something which really is very valuable, especially for merchants. Paytm did something stupid, which in our view, which is also sit and try to run a highly regulated banking business. Now, just the way tech entrepreneurs work, they hyper focus on growth, they hyper focus on building things. Uh, the regulatory complexities around KYC, right? And you just have to see banks like Kotak and HDFC and Bajaj across the board, traditional, large, established, top line kind of banks and NBFCs have been hauled up by kind of the RBI because of these KYC related issues. When you're dealing with crores and crores of kind of people handling small elements of, does an Aadhaar have a green tick mark or not? Is there a question mark? All of these are kind of areas that cause problems. They should arguably not have been in that business. They they were trying to run a payments bank. That part basically failed, right? And that was basically what was hauled up. And they've said, and the RBI is basically trying to close down that particular bank. However, what happens is that the Paytm payments app, which is always the core, which is the bank really didn't contribute too much to value in any perspective. That is something which is largely, from a longer term perspective, undisrupted, right? Yes, you have lost a certain amount of consumers. Yes, there's been negative press. However, if you look at it from a 4 to 5 year perspective, 5 years down the line, who would we believe to be the top 2 or 3 payment apps in the country? In our view, it's going to be a PhonePe, a Paytm, and probably a Jio Money. Now, why is this business so attractive? It's important to understand that payments or UPI payments and the whole payment infra is actually a customer acquisition tool. It's not the area that you focus on to make money. What makes money in these businesses is that it is very, very valuable to be the one app that the vast majority of users actually open more every day. The moment you exclude a Facebook, a WhatsApp, and a YouTube, some of the social media kind of apps, the one app that people are opening every day is their payments. Now, they're also associating this with financial transactions, and therefore the ability to cross-sell a loan product, an insurance product, say a mutual fund, various forms of products are extremely easy. Now, when you're talking of financializations of savings and catering to a much larger India, it is fundamentally not cost feasible for a bank on NBFC or a capital market player to go reach that marginal consumer. The person who wants a 2 or 3,000 rupee loan cannot be serviced in a cost efficient manner by a bank which needs paperwork to be filled out and various complexities. Paytm on its app using digital methods can actually deliver a loan instantly because you have KYC, you've got kind of your credit scores, you have past payment behavior, etc. None of these risks are on Paytm. They are just being a distributor of loan. They become a very, very valuable channel partner for traditional banks and NBFCs because they allow them to reach a very, very profitable consumer base, which is untapped. Now, when you look at that opportunity, that is a really large long-term opportunity. We believe that 4 to 5 years down the line, the whole financialization of savings and the ability of auto rickshaws, small shop owners, all of them to have access to the modern financial ecosystem is going to be driven by these kind of payment apps. And the margins in the space just for distribution, no credit risk, not running these products on your own are very, very valuable. And that is something that we believe is not been disrupted from a longer term perspective. If we're saying 5 years down the line, what kind of market share do I see Paytm having in the space? What kind of margins do you think they could make? All of those numbers look very, very attractive. And which is where, and another point, while the stock has actually fallen quite significantly, we actually took benefit of that. We averaged down when the stock had gone down towards the 450 kind of levels. We are actually now positive on Paytm on our portfolios.
Ashi, will you invest? Vittal is asking, will you invest in data center companies as it is the backbone of digital disruption? And then there's another question after that, and we can close out after that.
So let me give a mostly no. And the construct of the mostly no is that it is very important for us to believe that the companies that we're investing in are one, dominant, they own the space, and there's a very clear path towards the supernormal kind of longer term profitability. A pure data center company, when you're competing against the likes of an an Amazon or a Google, very large established players. Yes, it's clearly a space for smaller companies who are really able to tweak uh, requirements a lot more than some of the larger companies to really operate in. But is there clear long-term disproportionate value creation? And is there something that uniquely different of one data center company from another? Um, we're not sure whether it really meets some of those stock selection principles. Now, one element of what we've started in the portfolio is we've adopted something called a string of pearls approach. There can be certain, more than like data service, which is more like infrastructure, there are certain software as a service, SaaS companies that are seeming reasonably interesting to us. They don't necessarily have the same level of dominance, clear path to profitability, etc., of some of the pure digital platform businesses. But these are digitally native software as a service companies. Some of these seem quite attractive. We may include these as smaller weights as of the overall portfolio. But very importantly, they need to very clearly meet this whole digital first, digital native business.
Ashi, Anurag is asking if there is a benchmark, and if there is, what could be the estimated alpha? I see you smiling. You obviously anticipated this question.
Yeah, no, no. So See, honestly, there is no benchmark. I'm sure a benchmark will emerge some point in the future. I don't think the IT index is a decent benchmark because the growth profile of these companies is substantially different from that of IT services. What we really take as our benchmark internally is we believe that like we outperformed your kind of traditional benchmarks, your larger benchmarks, that is really what we're seeing. As in, according to us, investors have an option of investing in a diversified fund or going in for concentrated thematic strategies such as digital disruption. In order for that investment to actually make sense, it is very important that this theme outperform the overall markets. And that's really, I think, the focus of the benchmark. And that's really kind of what we focus on. And very importantly, when it comes to comparing against a benchmark, what our real focus is that we see this as a private equity fund, stay invested 5, 7, 8, 9 years. We believe you will significantly outperform the overall markets. However, there may be some years where you significantly outperform, maybe some years where you significantly underperform. This is not a portfolio for someone who's focusing on year-on-year returns. Forget quarter-on-quarter. Look at this like the way you would invest in a private equity fund. Money goes in, it's locked in for 5, 7 years, and you really benefit from that longer term value creation. So I also don't think a benchmark is necessarily appropriate from that perspective.
Um, what is your churning of the holding and how often? And also there is a question about Blinkit, and a couple of people have asked how will heating up of competition in quick commerce impact Blinkit? So there's a Blinkit question, and there is something about churning of your holding and how often that happens.
Okay, so churning of the portfolio is expected to be very low, right? So I think last year it was sub 10%. And also interestingly, the majority of that churn was actually caused by a risk control, where we have a 25% limit on a single stock, and Zomato just kept breaching that gap, right? It would outperform, it would go above 25, we'd cut down, it would again go above 25 on the lower thing. That actually caused the whole idea is that we expect this to be lower churn because it is a long-term buy and hold. And we really, if companies are creating a tremendous amount of value, you can really keep just sitting on that and enjoying that ride. It's like buying HDFC in 2002 and staying invested till 2020, really going in and out doesn't make any sense. I think a lot of the churn that may happen would be because as new companies get introduced, someone mentioned Swiggy, right? We would want to include Swiggy in the portfolio. We're currently fully invested, so we would have to generate some cash to buy something like a Swiggy. You probably see some of that happening, but this will be a very low churn portfolio.
Blinkit?
Sorry. So you're going to just forgot one question. In terms of alpha overall, we don't expect year-on-year alpha. Don't focus on that. I think the way we look at it is it's a longer term portfolio. We expect, say, for example, from a 5 to 7 year perspective, if the overall markets deliver something like a 15-18% return, we would expect this portfolio to be able to generate somewhere close to 20 to 25%, right? And when you're compounding over a longer term, this difference is something which is quite substantial. Please don't expect 100% to happen every year and a half. I think that is something which is clearly not sustainable. But the ability of this to significantly outperform overall markets over the longer term, right? We have no clue what will happen in the short term, but over the longer term is something we are very clear.
Ashi, I think we can wrap it up here. Thank you so much. We do have a couple of other questions, and we can take more.
Fine, actually, if participants are there, we can continue. That's
yes, sure. Okay. Bhavya is asking if the 100% plus returns in this strategy in the last year are mainly resulting from Zomato. I figured a lot of people would have that on their mind as well.
So there is a substantial contribution from Zomato. There's also a pretty decent contribution from Policy Bazaar. Both of these would be outliers in terms of the percentage of kind of contribution that would have emerged. But importantly, this is the way you would expect a concentrated private equity style fund to operate. there will be certain winners that are disproportionate and actually drive a lot of the value creation. So yes, the answer is yes, there are 2 or 3 companies that we had very large weights in that actually did drive that kind of value creation. And it's also important to kind of just understand that we've been able to deliver this. Paytm was actually amongst our larger weights, right? And after taking a substantial hit on Paytm initially, right, we've still been able to outperform and outperform quite significantly. So it will. There will always be, even going into the future, we'd expect certain larger weights to be disproportionate contributors to performance.
Sandy is still on this and he has asked a question. I see a lot of cash in hand in the portfolio. Is it the norm or do you have some spread in mind?
I'm sorry, I'm not sure where you got that data from, but there's very little cash in the portfolio. It's probably some 2-3%.
Okay. Bhavya, you're most welcome. Bhavya has said thank you so much. Nitin also want to say that we are so happy that you like the presentation. Nitin Dani is very happy with the presentation and says thank you for sharing. So I'd like to thank everybody for joining in today, and thank you so much, Ashi. I think a lot of people were, wanting to also know more because the questions have been about a lot of things that you have brought up as well, and I think some of the stuff that you've been talking about on the shows too. Thank you everybody for joining in. Ashi, if there's anything else you want to say, then you could.
No, that's it. Firstly, just thank you everyone for spending the time. I hope you found the strategy kind of interesting. I'm sure most of you are already connected to a private banker at IME Capital. Please feel free to kind of reach out if there are any kind of questions that you have. We'd be very happy to address them. And thank you once again.